Investments are necessary to be made if you want to make money. Nobody ever got to being rich while saving their money in their account. If you, too, have money, then don't let it rot away. Start investing in places you think are legitimate, and they will bring you good returns. We've chosen the word legitimate due to the presence of a lot of scammers out there. You will need to keep this in mind. And since you'll be a private investor, then you'll have to be even more careful of where you pump your money into. Private investments bring large amounts of money to the table. To invest in something and get a healthy return needs to be a surety. Suppose you're a private investor and can't figure out where to start, then no need to worry. We are bringing you the 8 rules you should know as a private investor. Number 8. Never lose money. The first rule that you should know is that you never lose money. When you have more money in your portfolio, you can make more money on it. So a loss hurts your future earning power. As easy as it might sound not to lose money, it is a lesson to let us know not to become enchanted with an investment's potential gains and look at the potential downsides. It makes us wary of all the things that could happen with our money. That is one of the reasons many investors tend to avoid long-term bonds now. Focusing on the downside first is what's important. When you look at all the pros and cons, you will only come up with a claim to invest your money into where you are investing it. Every factor needs to be held accountable before you carry out any investment. Number 7. Think like an owner. This mentality of thinking like an owner counts for a lot. Yes, okay, you're just investing your money, and you don't have that much of a say in the operations, but the way you can manage investing your money better is if you think more like an owner and less like an investor. Of course, that will need you to familiarize yourself with the operations the company plans to carry out and the company's whole point. It can be challenging to hear hours of plans, but these plans hold a lot of insight for being a better investor since you get an overview of the entire program to help you think like an owner yourself. Once that happens, you'll start seeing the whole picture differently. Number 6. Focus on the long term. Make sure to keep in mind the bigger picture with whatever game you are playing. Don't just go in for small and quick profits. The longer you play, the better you'll understand the entire game of investment, and that is when you'll start getting better ideas on how to manage your investment better. Small amounts of money won't bring you consistency. Whereas spending a healthy cut at the start to make sure your investment gains significant ground, as well as the project you're investing in, is what counts. Investing requires a lot of critical thinking, and you don't need to invest in small projects that try to give you a quick profit in a hassle. Invest a decent chunk in giving your money time to grow. The results will soon be in front of you. Number 5. Visit the company. One of the best ways to know what you're investing in is to see what you're investing in the close-up. What this means is to analyze what the company is offering from a closer eye. This could be done by examining what the company spends on their cars, dress, offices, etc. These little things might sound insignificant at first, but they will help you come to a decision quicker than ever. Furthermore, for more fact-based evidence, you can examine their sales and marketing system to make sure they've developed a pipeline to sustain growth and understand how your investment will accelerate that or take them into additional markets. Once you invest, then the time for monitoring that company is over. That will be the time when you can pray that the company flourishes. Number 4. Know the leaders. There's a vast difference between the investors who know the company's leadership compared to those who don't. And as you guessed it, the people who are in touch with the team turn out to be better investors compared to those who aren't. In addition to trust factors, there is always comfort in knowing the firm's history and what its growth pattern has been. Even if you don't know the founders directly, use your network to learn about upcoming companies that may need capital. Hundreds of startups could potentially be the billion-dollar companies of tomorrow. You need to pick the correct guess that the company is the one you're investing in. And that is only possible once you get to know the brains behind the entire project. Number 3. Do your homework. Investing blindly isn't recommended, no matter how good the company is functioning. Without proper research or a basic understanding of the company, there will come a time where you're eventually going to fail, even with a considerable investment at your hands. Have a meeting with the entire team where your money is going to go. Even if you have the slightest of doubts, you have the authority to call off your investment as you will be the one bringing your power to the table. If it's an idea that you believe in and the company having a good record in the books, it is advised to go ahead. Researching on the past as well as their future potential is your absolute right. Number 2. Understand business models of the companies you invest in. Understanding the system of the companies that you put your money in is a necessity. Businesses with sound strategies and precise projections are bound to be financially more robust in the long run. Do not put your money in a company whose approach you are having a hard time understanding. Putting your effort and money into an idea which you can't understand is pointless. Since you don't understand the entire thing, chances are it may be something illegal that is being done behind the curtains. And since you're the investor, then everything will be traced back to you. So even if there is a slight irregularity somewhere while you're being briefed about the business model, you have every right to question it, and if things go south, you can back off completely. Number 1. Never take loans to invest. One of the golden rules to know if you're a private investor is never to take any loans to invest your money. There are several reasons for this. Since you'll be under debt, then you'll need to pay off the money as soon as possible. If your company doesn't show progress in the given amount of time, it will be harder for you to pay the debt. Don't put your company in such a risky position where the job gives you such immense stress levels. If you have a small amount to invest, then invest it while promising more money on the way. Just picking up a loan and investing all of it isn't a sensible move by any means. If your partners wanted that, wouldn't they've gone directly to a bank? Think about it. Make sure to subscribe the channel and press the bell icon for more interesting videos in the future. See you next time.